gentlemen, good day and welcome to Diffusion Engineers Limited Q2 and H1 FY2026 earnings conference call. This conference call may contain forward-looking statements based on the beliefs, opinions, and expectations as on the date of this call. These statements are not guarantees of future performance and involve certain risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need any assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that the conference is being recorded. I now hand the conference over to Mr. Prashant Garg, Chairman and Managing Director from Diffusion Engineers Limited. Thank you, and over to you, sir.
Good evening, everyone, and welcome to Diffusion Engineers Limited's earnings conference call for the second quarter and half year ended 30th September 2025. We are delighted to have you join us today. I'm joined by Mr. Ramesh Kumar N, CEO, Mr. Abhishek Mehta, CFO, Ms. Concall Jaiswal, Company Secretary and Compliance Officer, and our investor relations team from Adfactors PR. The investor presentation and media release have been uploaded to the stock exchanges and are available on the website. Before we dive into the quarterly performance and strategic development, let me briefly introduce our company for those of you who may be new to our story. Diffusion Engineers Limited, incorporated in 1982 and headquartered in Nagpur, is one of India's leading engineering solutions providers, specializing in welding consumables, wear plates and wear parts, and heavy engineering equipment. With over 4 decades of deep domain expertise, the company serves mission-critical maintenance, repair, and industrial performance needs across core sectors such as cement, steel, power, mining, engineering, and sugar. Dell has built a unique end-to-end integrated business model, one of the very few companies in India to manufacture specialized electrodes, flux core wires, composite wear plates, ready-to-fit wear parts, and large heavy engineering equipment under a single platform. This vertical integration allows the company to ensure superior quality, enhanced cost efficiency, and deliver high reliability to customers with demanding application requirements. Company's products are essential for combating wear, abrasion, and corrosion in heavy industrial operations. Its strong engineering capabilities support the manufacturing of critical equipment such as high-pressure grinding rolls, industrial fans, air separators, and wagon couplers. Over 80% of revenues come from repeat customers, reflecting long-standing relationships and deep customer confidence. Dell operates modern manufacturing facilities in Nagpur, providing a strategic logistical advantage for dispatching large industrial components across India. The company also maintains a global footprint, exporting to 30+ countries across Asia, Africa, Middle East, Europe, and North America. With its IPO-funded capacity expansion underway, including new welding consumable capacities, enhanced wear plate output, and a new heavy engineering facility, Dell is poised for the next phase of growth. The company is targeting significant scale-up over FY27-29, supported by current strong order inflows, operational excellence, and a shift towards high-value engineering products. Diffusion Engineers continues to build on the legacy of innovation, reliable engineering, and customer-centric solutions, positioning itself as a preferred partner for industrial performance and maintenance solutions in India and abroad. Coming to our strategic and operational update, we are pleased to share that Diffusion Engineers Limited has received significant orders in the last 2 quarters, further strengthening our order book and enhanced revenue visibility. Our healthy order book of over 170 crores, driven by strong demand for Oleflex rolls for cement sector and heavy engineering applications, reflects the confidence that customers place in our engineering capability, product reliability, and long-standing industry relationships. These developments position us well for sustained growth in the coming quarters. With new capacity scheduled to come online by the end of FY26 and the completion of our ongoing CAPEX, we are targeting to double our top line in the medium term. We are also expecting EBITDA margin expansion supported by economies of scale, improving operating leverage, and an enhanced product mix driven by high-value manufacturing. Looking ahead with robust order book, healthy demand across sectors, and our operational initiatives, we are confident of delivering sustainable growth and improved profitability in the coming quarters. I extend my sincere gratitude to every member of the Diffusion family, our valued clients, creditors, bankers, financial institutions, and all other stakeholders. Your trust and support continue to inspire us to strive harder and achieve greater milestones. As always, our core values such as engineering excellence, customer commitment, and long-term stakeholder value guide through our journey. With that, now I would like our CFO, Mr. Abhishek Mehta, to take you through Q2 and H1 FY26 financial performance.
Thank you, Prashant sir. I will now walk you through our financial performance for Q2 and H1 FY26. Standalone financial performance highlights for quarter ended FY26. Revenue from operations for financial year was rupees 799.61 million in Q2 FY26 as against 743.15 million in Q2 FY25. YOY increase of 7.60%. The company has delivered a strong set of results showcasing continued growth. EBITDA excluding other income was at rupees 111.86 million in Q2 FY26 as against rupees 108.78 million in Q2 FY25, increase of 2.83%. EBITDA margin excluding other income for the quarter stood at 13.99%. Profit after tax stood at rupees 99.13 million in Q2 FY26 as compared to rupees 87.16 million in Q2 FY25, YOY increase of 13.74%. Standalone performance highlights for half year ended Q2 26. Revenue from operations for financial year was rupees 1533.33 million in H1 FY26 as against rupees 1415.76 million in H1 FY25. YOY increase of 8.30%. The improvement was driven by enhanced operational efficiency and improved execution capability, supported by higher order inflows and better capacity utilization. EBITDA, excluding other income, was at rupees 198.40 million in H1 FY26 as against rupees 188.13 million in H1 FY25, increase of 5.46%. EBITDA margin, excluding other income for financial year ended, stood at 12.94%. Profit after tax stood at 241.16 million in H1 FY26 compared to rupees 151.78 million in H1 FY25. YOY increase of 58.89%. Consolidated performance highlights quarter ended 30th September 25. Revenue from operations for financial year was rupees 835.66 million in Q2 FY26 as against rupees 824.67 million in Q2 FY25. YOY increase of 1.33%, reflecting a year-on-year improvement and a solid base for future expansion. EBITDA, excluding other income, was at 123.67 million in Q2 FY26 as against rupees 126.82 million in Q2 FY25. EBITDA margin, excluding other income, for the quarter stood at 14.80%. Profit after tax stood at rupees 101.65 million in Q2 FY26 compared to rupees 85.07 million in Q2 FY25, YOY increase of 19.49%. Consolidated performance highlights half year ended 30th September 25. Revenue from operations for financial year was rupees 1642.31 million in H1 FY26 as against rupees 1535.50 million in H1 FY25. YOY increase of 6.96%. EBITDA excluding other income was at rupees 229.49 million in H1 FY26 as against 219.04 million in H1 FY25, increase of 4.77%. EBITDA margin excluding other income for half year stood at 13.97%. Profit after tax stood at 224.30 million in H1 FY26 as compared to 157.80 million in H1 FY25. YOY increase of 42.14%. With that, I now open the floor to any questions you may have. Thank you for your time and continued support.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Suyash Bhave from Wealth Guardian. Please go ahead.
Sir, thank you for the opportunity. Sir, in the previous call, we had indicated that Q2 and Q4 are our stronger quarters. In this quarter, we had a relatively flattish top line, as in on both Q and QOQ as well as YY basis. So, are we facing any execution or demand-related issues? Can you throw some more color in this context?
So, you've asked about two things. One is demand-related issues and execution-related issues. So,
Yeah.
Demand, we are in fact, if you see our order book vis-a-vis last year and even at the end of the last quarter and end of the last financial year, it significantly improved. If you compare as far as execution is concerned, so we are not seeing any problem with the demand-related issues, and we are going forward, we are seeing a further improvement of the order book. Now, coming to the execution bit, if you see H1 numbers last year versus H1 number this year, there's a certain portion in our offering which is called as roller press rolls. Now, typically, we have a current order book of 100 plus crores of roller press rolls, but these orders take time for execution because it involves sourcing of heavy forgings which have a long lead time from Europe. And by the time they come to us and we do further value addition, it's a lead time of 8 to 9 months, sometimes extending up to 10 months. So some of these orders which H1 last year we had executed close to 20 CR worth of these orders last year, it is not contributed as much in this H1. But we are seeing that in the course of execution, these numbers will start coming in Q3 and Q4. So that's why Q2 looks flattish this year. But other parts of the business has shown improvement, and it's only mainly because of the reduction in the roller press orders that Q2 has come out to be flattish.
Oh, okay, fair. That makes sense. And regarding the order book, so yes, we have a very robust order book growth in this H1, almost 100 crores of new orders, and mainly led by the heavy engineering vertical. Have we taken in these orders for good margins, or did we have to adjust our margins to secure these orders? And in general, going forward, do you see the revenue mix tilting more towards heavy engineering division?
So, the reason why heavy engineering looks bigger in the total order book is because the heavy engineering comes with a longer lead time, whereas welding consumables comes with a shorter lead time, and wear plates and wear parts are in between these two segments in terms of lead time. Now, coming to the part of question, your part of the question regarding the margins to book these orders have come in as a result of the work that we've been doing over the last 3-4 years. So the total order book stands at close to 209 crores, out of which 170 crores is from heavy engineering. Now, a large chunk of this comes from the initiatives that we have taken last 3-4 years back, and we delivered those items in the industry and they started performing, and the customers come back and order for more. So we don't see any reduction in the margins for these orders, and going by the current raw material price trends, in fact, if anything, the margins are going to be slightly better only in comparison to what we had executed them before.
Okay, so understood. So one last question. So going forward, we don't see a major tilt towards heavy engineering, as in it will still be an equal revenue mix, or would it be a more heavy engineering dominated mix?
So the industry is also moving away from buying just products towards wear plates and wear parts, and also going towards heavy engineering, because when we just sell welding consumables, it requires the end user to hire skilled labor to apply these consumables on their industrial equipment. So clearly the direction in which the industry is moving involves sourcing of more and more of wear plates, wear parts services, as well as heavy engineering, and therefore there will be the increase in the business coming in from heavy engineering, wear plates and wear parts will be far more. The growth there will be faster than the growth in the welding consumables business.
Okay, sir. Understood. Thank you. I'll get back in the queue.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. The next question is from the line of Sunil Chen from Nirmal Bang Securities. Please go ahead.
Yeah, congrats for good increase in order booking. So my question relate to expansion. Can you talk about the status of both the expansion?
Yes, sir. So we have expansions going on at 2 sites. One is at Nimji plant, and the second one is at B33. I'll start with Nimji first. So in Nimji, we are almost at the plinth level in the construction phase of our new facility that we are expanding behind our existing facility. The erection is going to start from this week onwards, and we're expecting to finish the building by the end of the Q4. Already we have, as far as the electrification is concerned, we have got the necessary approvals. The order for high tension items have been placed, and they are in advanced stages of execution. Also, the most important thing in our facilities are overhead cranes. So they are also in advanced stages of production, and we are expecting deliveries to start from the month of January. So by the time building starts getting ready, the cranes will also be erected and ready. So we're expecting that the plant should be up and running by end of Q4, and we're on track for that. We have all the necessary approvals for that. As far as B33 is concerned, we have already received the 10-ton extruder to increase our manufacturing capacity. We have also received the slitting line. So both these plants are expected to go online from this month onwards, from November 24 onwards. And we have already started using the space for testing of our welding equipment, which we sell also in our product line. So B33 is also going as per our planned activities. Only the office block that we wanted to make in B33, that we have still yet to start, but we don't foresee any operational sort of we don't foresee any any delay in the benefits that we get out of it, because it's finally an office block, and currently we have enough office space in our facility. But as far as production activities are concerned, they are on track to be online by November, within this month in B33, and in MG plant by Q4 26.
Okay.
One more point I wanted to add was that we have already received the 1.4 megawatt solar rooftop plant at our site, and that also should get live by February, latest by January, end of February in MG plant.
So, for the main plant, Nimji plant, are we started booking order or still there is some time for that?
Yes, sir. So this heavy engineering order, after the expansion is over, the entire plant will become seamless. The existing plant and the new plant. And the heavy engineering order that we have will start immediately getting executed in the new space that we are creating behind the existing plant. And some of the machines for the new plant has already been installed in our existing plant temporarily, so that we are not waiting for the new facility to come live before we start producing. So those things have also been taken. And this 200 crore order book that you see, a good portion of this order book will start getting executed in the new plant. We don't need separate approvals from our customers to, get that plan validated, because as I mentioned, it will be seamless with the old plant. So it will be considered as an extension of the same facility. So we will save on that time to start executing orders there.
So from this expansion of Nimji, are we likely to get any revenue in the current year, or it will be starting from the next year?
So predominant contribution will come from the next year onwards. But as I mentioned, the few machines that we've been able to accommodate in our existing plant, which was originally planned for the new plant, that has started contributing. They've come live only, from October mainly. So that will start contributing in this year also. So some contribution will come, but majority of it will come in the next year only.
Okay. This the order book which we have of around 200 crores, what could be the execution timeline for the same?
So I think only the OE orders and the roller press orders for which there are scheduled deliveries, that will go in the next year, which is approximately
is about 80 plus crores.
Yes, approximately 80 plus crores will go for the next year. The balance are to be executed within this year, out of the 209 crores.
And if you can talk about demand scenario, if that's great. That's my last question.
So we see increased industrial activity on account of the expansion going on in the steel, mining and the cement sector. There is robust demand for new equipments in these core industries. So the business that we supply to for the new project build is seeing substantial increase. Also, the fact that we've been able to develop capabilities in the mining sector and in the aluminium sector, as we mentioned before, we are seeing more inquiries and requests for quotations from those sectors also, because we've been successful in supplying them large equipment such as crushers and wagon tipplers. So those sort of inquiries have also started coming in. We've added some new customers in the mining sector. This is as far as the new project build business is concerned, which, if you remember, is not more than 25% of the total business. As the industrial output increases in the core sectors, the OPEX budgets have also increased. So there is, the demand for spare parts, maintenance, services, and consumables to keep their plant up and running has also gone up significantly. Of course, there is a lot of consolidation which has happened in the industry, which is good, because if you supply in one plant, you can immediately get inquiries from the other plant. But also, it increases competition because, there are fewer customers because of consolidation and all the suppliers are focusing on that. So as far as the OPEX part of the business is concerned, where our products are getting consumed for the operational and running of the plant, that is roughly 75% of our turnover comes from that. We are seeing increased activity there also. And we see this increase in demand getting sustained over the period of short to medium term.
Thank you very much for answering my question.
Thank you, sir.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. The next question is from the line of Parth Patel from Patel Investments. Please go ahead.
Good afternoon, sir. Am I audible?
Yes.
Yes. Yeah. Thank you so much for giving me the opportunity. The first question is that if we see quarter on quarter, your finance cost went down and it came up again by about 2 million this quarter. So is this working capital loans or is this long-term loan that we have taken?
This is the working capital loan which we have taken. It's not. We don't have any term loan in this financial year.
Okay, sir. Got it. And secondly, I had a question on the order book. So what is the sustainable level of order book that we are planning to have over the next few quarters?
Ramesh, you want to take that?
Yeah. See, as earlier question Mr. Prashant was saying, the industry is, core industry is considerably growing. So we don't see a big downfall as far as order backlog is concerned after the quarter. But definitely it will be little less because in the quarter 2, if you see specifically, we have got almost about 170 crores, which also contributed by the roller press roll, what Mr. Prashant has said earlier. So there may be a slight reduction in backlog, but definitely it will not be too much reduction, what I can say.
So if we take from a level of 200 crores, so we will be around 170, 180?
Yeah, maybe 170, 180. That kind of thing, I think we should be in a position to maintain for next couple of quarters.
Okay, got it. And the last thing is that you have reiterated that you'll be seeing a double-digit for 6 and 20 to 25% growth for 27. So I just wanted to see what are the challenges and what are the strategies you have in place to achieve that.
So one is, the most important thing is that we need to have the orders to be able to sustain the double-digit growth. So that clearly you can see from our order book that we have a substantial order book. Second is, the order book needs to align with the quarterly performance and the quarterly delivery so that, quarter on quarter or yearly at least there is an increase that we are promising. So, we as I mentioned, out of the 209 crores, 80 odd crores is planned for the next year. The balance 130 crores is already in the bag, and we are still at November mid. So we still have 4.5 months to go for taking new orders and executing in this year. So, we have the order book. We have also got enough time left to be able to execute, and the long lead orders that had come in the Q2 and Q1 are now getting ready for deliveries in Q3 and Q4. So all of that will contribute and that will help us enable, achieve that number. Also, the fact that the new electrode facility will come live now, the wear plate machines that we have added in our existing space, which is planned for the new space, has also come live. We are adding one more machine because we are there is limitation of space, but we are able to accommodate one more wear plate machine, which will add to the production capability and turnover, which will be visible in Q3 and Q4. So we are confident that what we've been claiming we'll be able to achieve by the end of this year.
Good. So if I have some time, I just wanted to ask what is the current capacity utilization we are at, and now there is now as you're mentioning that there is a sort of a lack of space. So once the new machine is set in, how are we planning to expand the capacities going forward? Is there going to be a land acquisition or any third-party contracts that you are going to look at?
No. So the moment we try to outsource our manufacturing activities, we will lose out on margin, and also we are not more than the margin, the quality is a question mark. So and that is how Diffusion has developed its capabilities, as basically investing in in-house facilities. So we don't believe so much in third-party contracting, especially for our core manufacturing such as electrodes, wires, and wear plates and heavy engineering. But coming to the expansion, so we have 30 acres land in that premise where we are putting up the new workshop. So land shortage is not a problem. It's just the space, the factory shop floor space that needs to get ready so that the space is available. So the moment that happens, once we have more space available, then obviously our fabrication and manufacturing capabilities will increase significantly, and we will have more space to execute these orders. And with the existing space, whatever maximum we can accommodate, we are accommodating. We are not waiting for the new facility to get ready. That's what I meant to say.
Got it. Just one last question. So in the land, so once you run out of the workspace over here and you start building another workspace and bringing in all the machinery, what would be the average time it takes to start it running, and what would be the cost it would that we would have to incur?
So the time basically from concept to sort of build is anywhere between 8 to 9 months from thinking about expansion till the expansion gets ready. And money, of course, is depends on the size of expansion that we are doing. But typically, with an investment, so current investment that we are doing is roughly around 70 CR in the heavy engineering area in Nimji plant. And that is almost doubling our current capacity. So we don't foresee another such expansion immediately within the next two or 3 years. So even if some expansion needs to be done, it will be only maybe half of it. So going by that, roughly anywhere between 30 to 40 CR should be enough to carry out at least half of this expansion going forward. Of course, as we mentioned before, we don't have any long-term loan and any term loan, so we have the financial capability. If the market need is there, we can of course expand more if required, as the land is already there with us.
Absolutely, and I think we have enough reserves for this also.
Yes.
Got it. Thank you so much for answering my questions, sir, and I wish you all the very best for your plans ahead. Thank you.
Thank you.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. A reminder to all the participants that you may press star and 1 to ask a question. The next question is from the line of Suyash Bhave from Wealth Guardian. Please go ahead.
Yeah, thank you for the opportunity again. Sir, we had in our AR as well, we had mentioned about getting into more client verticals, defense, mines and railways. Any color on that? Any progress update or any orders we may have received there?
So mining, we have added a very prestigious new OEM and we are in advanced stages of executing one significant order for them. We are already in inspection stages after the manufacturing is in advanced stages. And from the existing OEM for which we had made a big equipment called as the tandem wagon tippler, we have received new orders and there are more talks for subsequent requirements from them. So mining OEMs business has started increasing and we are seeing a good pipeline of inquiries as well as business, not just inquiries coming from there. Railways, we got a couple of contracts for making parts of the Vande Bharat train parts, some critical parts for them. We were able to come L1 in a couple of opportunities, and now that thing is under order placement, and there are further discussions going on that front. The existing business in railways is also increasing, wherein we were supplying some wear liners for their ballast cleaning machines. These are basically track maintenance machines. So So that versatile business which was there is still there and it's increasing. And defense, of course, we are participating in requirements for welding consumables for armoring application. The earlier order which we had got, I think in Q4 last year or Q1 this year, is in the final stages of execution. So it was an order for 65 tons of welding consumables, and it's in the last stage of its execution, which will get over before the end of this financial year. There are new opportunities that we've identified in defense, but we will definitely share that once it comes to fruition.
All right, got it. Thank you.
Thank you. The next question is from the line of Vikram, an individual investor. Please go ahead.
Yeah, good evening. Thank you for the opportunity. Just a question in terms of your guidance where you talk about medium to long term and doubling revenues. Do you have a time frame in mind? Because that is pretty broad in terms of medium to long term.
So we expect to do that in 3 to 4 years.
Got it. And any sense of where we will end FY26? Because you did mention that we've got orders worth about 130 crores, give or take, in addition to the 160 odd that we've done in the first half. And then, of course, you've got, nearly 4.5 months in terms of winning new orders. Any broad sense of where we'll like to achieve for 26?
So we will maintain our outlook of, maintaining double-digit growth.
Okay. Because again, double-digit is very broad, so I just wanted to get some color in terms of. Yeah.
We would be in mid to late teens.
Okay. Got it. And in terms of final question on operating leverage, you did mention the fact that some of the new orders are coming in and potentially they could be at slightly better margins given where raw materials are, etc. Obviously, with scale, we will get operating leverage as well. What is a sensible EBITDA margin range that we should work with?
Anywhere between 15 to 17%.
Got it. All the best. Thank you.
Thank you.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. Ladies and gentlemen, as there are no further questions from the participants, I now hand the conference over to the management. Mr. Prashant Garg, Chairman and Managing Director from Diffusion Engineers, for closing comments. Over to you.
Thank you all for your participation and insightful questions. As we move through FY26, we remain focused on execution, innovation, and scaling sustainably. I would like to express my gratitude to our dedicated team members, valued clients, suppliers, bankers, and all stakeholders who continue to place their trust in us. For any further information, please feel free to connect with our investor relations team. Thank you and have a great evening ahead.
Thank you on behalf of Diffusion Engineers Limited. That concludes this conference. Thank you for joining us, and you may now disconnect your line.
If you found this video helpful, please like, share and subscribe to Concall India for latest upcoming Concall.